When you look at this current crop, this vintage, if you will, of IPOs that have been out there, whether it be the Ubers or Lyfts of the world, but also Zoom on the other end, which of course ended up 72% higher. Have you been buying into any of these IPOs?
Well, we try to get them on the deal. Some we hold, most we don't. I would just say that demand is what creates supply. There's demand for this type of paper, and you feed the ducks when they're quacking. And, I would say that these companies generally don't have earnings. They have maybe at most some EBITDA, and EBITDA to me stands for we have no earnings. And so it's not a place that I spend a lot of time trafficking in. I try to make money on things that have a multiple of their earnings rather than buying, pie in the sky. I had dinner the other night with the gentleman that runs the Vision Fund for Masasan, and I think it's been an $80 billion fund. And in the aggregate, the $80 billion which they've invested have no reported earnings. And that's not the world that I live in, and we're going through a cycle. And so Beyond Meat is what I think, I don't own it, is $8 or $9 billion market cap with no earnings and a huge multiple of revenues. And it's probably not a business that they're isolated from competition. There's no moat around that business. You're already seeing a number of companies in the food business getting into this vegetable plant stuff, whatever it is. So I would say that, to me, the IPO market is a little bit of a bubble. But you got to do it name by name. But it's, I would say, evidence of a late cycle phenomena.
Late cycle, a little bit of a bubble, or a lot of bit of a 1999 kind of bubble? Yeah. Which one?
Yeah, but I don't think you can generalize. The only generalization make don't generalize. In 1999, Cisco was 100 times earnings. Now everybody's nervous about Google at 21 or 22 times earnings. It's a different world. The valuations are very different. The valuations are not unreasonable in the aggregate. You have to look at each company one at a time. I think paying $8 or $9 billion for Beyond Meat, given what they generate in the way of earnings and revenues, no earnings and not a lot of revenues, seems to be extreme. And you got to be very careful. You got to know what you own. So,
do you look at this phenomenon of these companies staying private for as long as they have, and you look at a Slack or a Spotify, which is able to actually do a direct listing because they've raised so much capital in the private markets, some from companies and investors that historically were effectively public market investors, and what that does to the appetite and the demand issue?
I really have not spent enough time in that area to have an educated opinion. All I know is there's a lot of money around, and zero interest rates or very low interest rates lead to pushing people out in the risk curve. And this is what's happened over the last decade. Everybody's moving out in the risk curve. The guy or gal that bought T-bills said, I can't get by on 1%, so I'm going to take duration risk and I'm going to buy T-bonds. The T-bond buyer says, I can't live on 2%, I'm going to take industrial credit risk and I'm going to buy industrial bonds. I can't buy on 4%, that guy says, so I'm going to buy high yield. The high yield buyer basically says, I'm going to buy some collateralized loan obligations. And the debt player says, well, I'm going to put 25% of my fund in equities because they look more attractive than fixed income. And so everybody's spent the last 10 years moving out in the risk curve, and one of these days they're going to start coming in on the risk curve. And I would say if we have a few more days like yesterday, my guess is you'll probably be in that euphoria and you'll have to be pulling back. And I think, the conditions don't seem at the moment suggestive of any big decline. And like I said, free money leads to lots of action. The market is not expensive if interest rates stay here and the economy doesn't enter recession. I think that the Fed is acting like they're worried about some kind of recession. In Europe, basically, they're relying strictly on monetary policy. What they should be doing, frankly, is start to have stimulative fiscal policy, but Germany won't let them. Okay, but it's crazy. We should not be fighting this slowdown strictly through monetary policy. The U.S. is doing better than the rest of the world because we have stimulative fiscal policy and stimulative monetary policy. Europe has stimulative monetary policy, not stimulative fiscal policy.
Lee, if that's your position, if that's your view, if we moved up another 5% from here, would you get out of stocks? Would you?
Well, I would be reducing my exposure, absolutely, yeah.
You're not right now?
No, I'm not right now. I'm enjoying it. I'm about 75% invested in a family office, 25% I have in one-year paper that I invested at 3%, and I'm happy with that kind of mixture. And I think it's very hard if you're a long-term investor to initiate new positions in now, 10 years into a bull market, at valuation levels that we have. Because we're not traders. We tend to be investors, and it's hard to be a new investor in something at the current valuation levels.